Okay, people, what I'm going to be showing you now is how to do hedging, okay, or I'm going to give you an idea of what hedging is all about. Now, hedging is used in many ways to recover an account which is already in a jeopardy or can be in a jeopardy. It's one way of hedging your bets, if you like. This is where you get that saying from. So I'm going to go through this very, very shortly. What I'm also going to be telling you is, in some ways, this is what a expert advisor will work to. It's almost like a martingale effect. And what a martingale effect is, where basically it will take a trade, okay, and it will say it's $2 for a trade, and then it will fall below a certain point, then it will go to $4 below a trade, then it will fall below a certain point, and then it will go to $6 below a trade, and then when it goes back up, it will collect from the 2 to 4 which you've lost. It's then corrected from the 6, and it will make profit on that. So you can see how you can get into a lot of danger by actually using a martingale bot, because a martingale bot is designed where it will almost double its actual point that it's gone into a trade, whether it's a sell or a buy. And in some cases, you know, if the market has gone quite bad and gone the wrong way, you can get yourself into all sorts of trouble. But equally, if you learn to manual trade with hedging, this can become an asset and almost an ATM ready for you to start cracking on. So what I'm going to be doing is I'm going to be going over this process just to give you a insight before we go into a training tutorial, and then I'm going to explain to you with some diagrams of when you would get into a trade and when you would get out of a trade. Okay, so it's just going to give you a few concepts which hopefully is going to help you on your trading. Okay, now this is the Just Trading program, which is also included inside the academy. So of course, if you are interested in my academy, you just need to click the link below inside the description. It's going to give you access to all that great stuff. Okay, so basically hedging and trading involves taking steps to reduce or eliminate the risk of adverse price movements with inside an asset that you hold. It's like taking out insurance on your investment to protect you against your potential losses. Here's a step-by-step explanation of how to trade using hedging. So really, you've got to try and understand the concept of hedging, where the purpose is, the main goal of hedging is not to make a profit but to protect against potential losses. Risk reduction. By taking an offsetting position, you can mitigate the impact of a negative price movement with inside the original position. Common markets. Well, hedging is widely used in the stock market, commodity markets, forex and options trading. Okay, identify the asset to hedge. So if you're in the stock, if you own shares of a company and you're concerned about a short-term decline in the price, remember when I was talking to you about that you could already be in a deficit with inside your own account, you can use hedging to aid your bets to get yourself back with inside a profitable margin. So the currency, if you have an exposure to a foreign currency and want to protect against the unfavorable exchange rate movements. Commodities, if you're a producer or consumer of commodities like oil or gold and want to lock in prices. So choose a hedging instrument. Well, options, these are contracts. Okay, now put options, call options I haven't actually gone into. This is more profitable, but although carries a higher risk. At the moment, most of the actual trades that I show you are with inside set up exchanges or brokers that you are already paying a certain price for. And this, you know, if you're using a exotic pair, can sometimes charge you a little bit more when you are actually taking out a trade and it's over a weekend. They would charge you over the weekend, so this is something you've got to watch out for, right? I think I released a video once where I made $740 and lost $390 in actual charges. You know, so it's just something that you really need to be a little bit aware of. You know, and have a look around, because there's some great information with pips of what people and brokers are offering you. This is why it's always advisable to use a demo account first, or if you can afford it, to have your own account with your own money Of course, you're risking your own money, but you will still be charged through the brokers, etc., because they are going to be charging you a swipe. Okay, it's almost like this is their way of making a little bit of money from you while you're doing that. This is one of the very reasons I use a Darwin X0 account, because that works very, very well. And also, when you get to your allocations point, you can then swap it over to your own Darwin account, which gives you greater potential to having more profits. Okay, so options contracts is something that we won't be going into just yet, because this is quite complex and there has to be a certain procedure and a way that you do this. Also, if you're in a different country, sometimes in America, and your options fall below a certain point, the broker will charge you and expect you to pay for the fees. So this is a hidden fee. This is something that you have to be very careful with stocks as well. So you need to make sure that you read the contracts if you're signing into anything, and also make sure that you read and take a lot of information in. If you're not quite sure, what you need to do is do a lot of research, your own due diligence, to make sure that you're not getting yourself into certain things. Okay, so the future contracts, this is by entering a future contract. You agree to buy or sell the asset at a predetermined price in the future, locking in your price today. Short selling, if you own a stock and expect a temporary decline, you could sell short with an equivalent amount of stock to hedge against this decline. Currency hedging, using forex contracts or options to protect against unfavorable movements in exchanges rates, and then inverse ETFs. These are funds designed to move in the opposite direction of an underlying asset. These are almost like correlations. Okay, very similar to the last video I did about USD CAD and XAU USD, where gold will go up and Canada will come down. Okay, and there's lots and lots of things like that. There's USD JPY, which tends to come down when USD or XAU USD goes up, and there's loads and loads of different correlations. The implement of the hedge, so determine the amount to hedge, decide how much of your positions you want to hedge. I mean, it could be partial, you could be hedging only a part of a position or a full position. Set up a hedge, for example, if you own say 100 shares of the stock and you want to hedge against a potential decline, you might buy one put at a time, since one option typically covers 100 shares. Okay, monitor the hedge, regularly check the performance of both your original position and the hedge, adjust if necessary, especially if the market conditions can change. Understand the costs and the risks. Okay, so cost of hedging typically typically involves a cost such as a premium paid for an option, which could reduce overall returns. Risk of overhedging, if you overhedge, you might protect against losses but also limit your potential gains. And complexity, hedging strategy sizes can be complex and may require an understanding of derivatives and specific market you're trading in. So you've got to be something that you're almost a specialist with, or you've done a lot of research before you go into that particular trading symbol that you're going for. Close or adjust your hedge. So exiting the hedge when the reason for the hedge no longer exists, e.g. the risk has passed, you can close the hedging position. Adjusting the hedge, if the market conditions changes, if your outlook changes, you might need to adjust the hedge by increasing or decreasing or rolling over to a new hedging position. Now evaluate the outcome. Okay, so review after closing both the hedge and the original position. Review the overall performance. Did the hedge protect against the loss as expected? Were the costs justifiable? Okay, example. Okay, so we're just going to give you a little bit of an example here. So suppose you own 100 shares of stock currently trading at $50. You're concerned the stock might drop in value over the next 3 months, but don't want to sell the stock because you believe it's a long-term potential. Now, a lot of this you could get trapped in, or actually be interested in, is crypto. Okay, because crypto can really go high 1 minute, it can come down really low. So a lot of people will hedge crypto, okay, because they will hedge it to a point where they know it's going to go back up, so they know that they're going to be in a more potential for them to be coming into more profit by doing that. So step one is to buy a put option. You'll purchase a put option with a strike price of $50, the current price and an expiration date 3 months away. The cost is the premium of put option might be, say, £2 per share. So what you're doing basically is by you actually putting in a put option at a longer time expiry, you'll get more of a discount. Okay, so that's how that would work, right? So step two is stock price drops. If the stock price drops $40, the put option increases in value, offsetting the loss in the stock. So step three is stock price increases or stays the same. If the stock price stays above $50, the put option expires worthless, okay, and you will only lose the premium paid $200. However, your stock maintains its value. By understanding and implementing hedging strategies, you can protect your investments from adverse market movements while still participating in potential gains. Okay, so I'm going to give you time just to digest that. And what we can do now is we're going to move over to a certain formula. This is called the Surefire Hedging Strategy. Okay, so I've given you an insight of what hedging is all about. Now what we're going to do is we're going to work with a graph which is going to give you an indication of how you can get in, how you can set your take profit margin and your stop loss. Okay, so we're just going to go over this and then hopefully this is going to give you an insight of, if you want to try hedging strategy, you'll be able to put this into action. Okay, so just for a simple explanation, let's assume that there is no spread, so take position with any direction you like. Example, you buy 0.1 lots at 1.9830 at the same time or a few seconds after pricing a buy. Okay, put sell stop at 0.03 lots at 1.9800 and look at the loss. Now what I used to do, okay, when I first started doing trading, is I used to buy and sell at the same time. And then what I used to do is, if it went up higher and higher and higher, okay, and I'm into, say, a couple of trades where it's going up, I've then cancelled the sell trade because I'm already making profit, which has already paid me for the sell trade that I lost. Okay, in some terms this is a hedging strategy. Okay, and this works quite well. This is what I'm trying to explain to you with inside here. So at the same time or a few seconds after placing buy, put a sell stop at 0.3 lots at 1.980. Okay, so what it means is you've got your buy trade here and then you've got your sell trade here with your take profit. Okay, so what you're trying to do is you're trying to find where it's going to bounce almost, and when you're going to be able to come out of the trade and go into the trade. Okay, so look at the loss. So what it's now asking you to do is to look at the loss. Okay, so if you look at this, it's giving you an indication, and also you would use your highest high as your stop loss. Okay, or you could use that as your take profit in the reverse of what you go. So if you got in as a buy, use your stop loss at your lowest low. If you go in as a sell, then you would use your stop loss at your highest high. Okay, and then you would work and determine whether you want to work from 30 pips to 60 pips. Okay, now you'll notice that this is broken into 30 pips take profit, hedging 30 pips distant. This is the distance from here and here. Okay, this is how this works. Now there is a formula which I'm going to be showing you, okay, or try to teach you. But if you take profit is at 19860 and it is not reached, the price goes down and reaches the stop loss, which is at 19770, which is here. Okay, so you haven't reached this here, which is that profit. You've hit your stop loss, then you have a profit of 30 pips because the sell stop had become an active sell order. So what this means is that because you place two trades, your other trade will activate, okay, because it's going up but then it's come back down, and then you're still making profit of 30 pips while it hits its stop loss. This is the reason why you have a buy and a sell at the same time. Okay, so basically the sell stop had become an active sell order, okay, which is early in the move at 0.3 loss. Okay, so basically it's going up at 0.1 lots, but also the sell stop where it's come down at 0.3 lots. Okay, so you're going to be making more because you're actually 3 times a more profit, even though it's coming down to hit the stop loss. Okay, remember this ain't going to activate. If this is up here and you hit your take profit, then it's not going to activate the sell stop. Okay, which means then that you're not in, you're still in profit. Okay, so as long as you're past this margin here, you're in profit. As soon as you start going down below this profit, this is when you hedge it your bet, because what it will do is we'll get to a point where you think, oh, you're going to hit your stop loss. Okay, it triggers the stop loss in a sell position. Okay, and then you're making 0.3, so you're making 2 times more than what you would have made if you'd hit your buy profit. And then when you hit your stop loss, you've already made 30 pips profit. Okay, so it's one to get your head around, but seriously, if you learn this, this is an art where you can actually hedge your bets. And I know I keep saying that, but that's exactly what you do, and you're protecting your profit. Okay, so if the take profit at 198C is not reached and the price goes down, the stop loss or the take profit at 19770, then you have a profit of 30 pips because the sell stop had become an active sell order, which is this one here. Okay, which is short early in the move of the 0.3 lots. Okay, so this is something you can do all the time. All right, so if you go up and it doesn't hit this your trigger, then it doesn't matter, you can just cancel that. So if it's gone all the way up somewhere here and it's found its new support resistance and it's bouncing backwards and forwards, you would just cancel this trade that you've got set up at 1.9800. okay, because there's no point to run it. Okay, so if you've hit your take profit at 19860 or hasn't been reached, okay, your stop loss reached and the loss is 60 pips, still made your 30 pips. Okay, because it's times 3, you've made 90 pips, which means that if we look at the profit margin, which was at 90, your loss was 60, but your net is 30, so you still made 30 profit. Okay, so if your take profit and stop loss at 19770 are not reached and the price goes up again, you have to have a buy stop in place of 1.9830 in anticipation. Okay, at the time the sell stop was reached and become active, the sell 0.3 lot, okay, which is picture number 2, which is this one here. You have to immediately place a buy stop of 0.6 lots. Now remember I said to you about the martingale? Martingale goes up, doesn't it? So what will happen is it will take a trade at 2, it will bounce, it will come down, and if it hasn't hit, then it will go to 4, and it will bounce, it will come down, and 6 and 8. This is the martingale effect, okay? And this is equally is how expert advisors, some out there work by doing this, okay? So it goes up, comes down. Okay, so I'm just giving you a little bit of an idea of what you would do. So for argument, okay, take profit is 1.9860 hasn't reached. Okay, you can see that this has fallen back down. It's hit the sell stop of 0.3 lots at 1.9800, and our take profit is at 1.9770. Okay, hasn't reached, right? This is when you need to put a buy stop in, right? So it's hung around here, it's coming back up. Okay, so the market has changed, if you like. The trend is your friend, you always check that, and you'll see now that it's going to hit the 1.9830. See how the buy stop has now been increased to 0.6 instead of 0.3, because this one here, which was a buy, okay, hasn't been triggered. It's come down to the sell. Okay, so even though we're into this profit, we haven't hit a take profit, so we're now in the red because we're at 0.3 lots. However, it's reverted itself, it's going back up. So what you do is you've doubled your hedging bet, if you like, by buy stop at 0.6 lots at 1.9830, and then you have your stop loss again, which is pretty much the same as what you would have had at your when you placed your first buy trade. Okay, and you notice that the stop loss is the same on your sell trade. Okay, so these are your support and resistance lines. All right, so if we look at the pricing, you notice that our profit was 210 pips. Okay, our loss was 180. We still made 30 pips in profit. Okay, so even if we don't hit our take profit or we don't hit our actual profit points, we're still going to be in a profit of 30 pips. All right, so again, this is something you really need to get your head around. If your price goes up and hits the stop loss or the take profit at 1.9860, then you have a profit of 30 pips too. Okay, so it's just something to bear in mind. So if your price goes down again without reaching any take profit, then you continue anticipating with a sell stop of a 1.2 loss. You double it. Okay, you then do 2.4 loss. And next continue this sequence until we meet the profit. So you keep doing this, but remember, you can only do this depending on the size of your account. And remember, each time you're going up, if you're working against the market, i.e. that there is news, you're going to run yourself into lots and lots of trouble. What you've also got to do is you've got to think to yourself, okay then, how much do I want to risk today? Right, so you might say that I'm going to run this just up to this point, okay, up to 2.4 loss. Then I'm going to just think to myself, tomorrow's another day, right? So I'm going to do this today. All right, I've lost 2.4 loss of my profit. Start again, because otherwise although you're hedging your bet, okay, and it's going up, you're still depending with inside that market. So you've got to be careful when you start to trade, if it's in a zigzag moment, okay, if it's just hit high news, you know, there's something that's broke out in, you know, on the news, on TV, and it's spiked the markets. This is a bad time to trade because, you know, it can go parabolic, and it just means that no matter how many of these you're going to put, you're just going to hedge yourself into trouble, if you like. But bear in mind that you are making a profit of 30 pips every time you do this formula. So with the example, if you use 30, 60, 30 configuration, your take profit is 30 pips and your stop loss at 60 pips, then your hedging distance is still 30 pips. Otherwise, you can try the 15, 30, 15, 60 to 120. Okay. Also, you can try to maximize your profits by adding 30, 60, 15 or 60 to 120, which are 30 configurations, right? Now, I did say to you that this is a little bit complex, but what I will tell you is that if you master this formula, okay, this will give you benefits in putting you into profits eventually. Okay, so actually the whole secret, if there is any, is to find a time period that the market will move enough to guarantee the pips for your profit. Euro USD, GBP USD, USD JPY, they're pretty good ones to get into. Okay, and of course gold moves quite quick, but it does have very swings, so there's something you want to be careful with. This strategy works with any trading method. Okay, so you can see here that this is a trade, so you can see that it's bounced down, it's gone back up, it's bounced down, it's gone back up. Okay, and you'll see that this is your line 1, okay, line 2, line 3, line 4. So you see Asian breakout using the line 1 and the line 4. So the line 1 is where it's gone into its throat and it's come down. And then you say here, play line 1 and line 4, also win now. Okay, take profit. So this will be a point where you come down, you take profit, come back down, it's gone back up, and you can take profit again. Okay, so you just need to know which time period market has enough moves for the pip you want. And one more important thing is not to end up with buy sell too many times until you run out of margin. Okay, so sorry, the above chart doesn't mark up the last trade, but buy 6, okay, which is this one here. So comments. So by now you have you can see the awesome possibilities of this strategy. In summary, you enter a potential trade in the direction of prevailing intraday trend. Okay, remember I said to you, trend is your friend. Okay, it's very important. Trend is your friend, because it says I would suggest using a 4-hour and a 1-hour chart to determine the direction. Furthermore, I would suggest using a 15-minute and a 30-minute as your trading and timing window. In doing this, you will usually hit the initial take profit target of 90% of the time, and your hedge will never be activated, as mentioned in number 7. Now, don't panic, okay? You will get this PDF. This will be included with inside the Just Trading module. If you're watching this on video and you want the whole of this module, then you'll be able to grab that, plus lots and lots of other stuff which I do with inside my trading academy. I'm just giving you a little bit of a rundown so I don't really miss out on that great stuff. So as mentioned in 7 above, keeping spreads low is imperative when using hedging strategies, but also learning how to take advantage of momentum and vitality is even more important. So as long as this line, I would suggest looking at some of the more volatile pairs such as GBP JPY, Euro JPY, Aussie, which is AUD JPY, GBP CHF, Euro CHF, GBP USD. These pairs will give up to 30 to 40 pips in a heartbeat, so the extra spread you will pay for these pairs is more than worth it. But I would still suggest looking for a broker with the lowest spread on these pairs. The trading model that I'm sending you with this strategy is based on the MetaTrader 4 indicators. Okay, these are going to be some other stuff which I'll be showing you with inside my trading academy. This is just a just trading scenario that we're using at the moment. So this is just typically showing you how to do the hedging in a manual trading status. Okay, so as I said before, the spread GBP JPY is probably very good because you're going to get 4 to 5 pips, where most of the brokers get 6 to 9 pips. In addition, these are based on an MT4 platform, but also you can use this on an MT5 platform as well, for opposing positions upon the same time on your same pair. Okay, so this is just something else you need to make sure is that you are able to hedge on your actual account that you take out as well, okay, or with a broker. So your trading line 1 and line 20, which is 10 pips, will also win. So if we look at line 1, which is this one here, okay, and our line 2, which is this one here. So remember what I said to you about that we're looking to see where support and resistance lines are coming off. You could almost use Fibonacci to actually recreate you these lines of points of getting into the market and out of the market. This will make life a lot easier for you. That would be Fibonacci retracement, which will help you to get into the market and out of the market. Okay, so this is something else you can do. So don't be confused. This method is very simple. It only takes 2 things. One is just choose 2 price levels. Okay, so you've got a high and a low that you decide. Remember, Fib's going to do that for you. At a certain time, you decide. If you break out H, then you buy. If you break out L, then you sell. Okay, take your profit, which is your highest low. Remember I said to you, highest high, lowest low. You can set up your stop losses. Every time you have a loss, increase the buy sell loss in the number of sequence. So it'd be like 1, 3, 6, 12, because you're doubling it every time. If you choose your time and price range correctly, there should be no need for as many trades. In fact, you should never have a need of more than 1 to 2 entries if you properly time the market. Okay, learning to take advantage of momentum and vitality is key element. Learning to use strategy, as mentioned earlier, timing and time period can be a crucial ingredient. Remember what I said to you about not trading when there's high impact news. Monitor what is on TV, because this is going to give you an impact of what's going on in the world. If you're not sure about that, you can always go to investing.com, or there's Forex Factory Markets, which you can actually look, and then we'll give you a news information there as well, which is going to help you. Even though the strategy can be traded during any market session or time of day, it needs to be understood that you that when you do a trade during the off hours or lower volatile sessions such as the Asian session, that it will take longer to achieve your profit goal. Okay, thus it's always best to trade during the prime hours of the European London session or the New York session. Okay, in addition, we all know that the strongest momentum usually occurs during the opening of any market session. So it's these times that can help you to trade with a higher probability of success. So it's momentum plus timing equals success. Okay, this is a typical example that market do not move very dangerously. Remember, this is in a zigzag motion. Okay, and this is when the markets are probably closed. So that's pretty much it, really. So the above examples are illustrating using mini lots. However, as you become more comfortable and proficient with this strategy, you can gradually start increasing the number of lots trades with an additional goal of working your way up to standard lots. The consistency that you will achieve by being able to make 30 pips any time that you want or want to lead into the confidence necessary to trade multiple standard lots. Once you get to this level of proficiency, your profit potential is unlimited. So whether you realize it or not, but this strategy will enable you to trade virtually with no risk. It's like having an ATM debit card to the World Bank. Okay, pretty much using my USD CAD to XAU USD bot, where, you know, I make, as I said to you before, I make an example and show you how that makes me money every single week. Okay, and everyone has access to that within inside my trading academy. So that's it. Hopefully this is going to help you. Like I say, I'll make sure that this is included. This is a surefire hedging strategy. This is giving you an idea of how to hedge your bets, if you like. I know it's a funny saying, but as I love saying this saying, shows you exactly how to set your profit, your loss, etc. It's giving you a actual template of success, which you will be able to put this into action and to start using straight away. All the very best until my next video. Thank you.